Right, it's been a great fun so far. I love chatting about IS2 and I've enjoyed chatting about it with you guys so far and just giving you a little bit more background hopefully than what you just saw when you read through IS2 on your own. It just all pulls it all together if you know a little bit about the background and things like that. But now we need to move into the more serious stuff. The actual measurement, the calculation of what inventories are going to be measured at. So this is going to take us most of the time. Most of this you do know. That's the great news. You have done this in your school accounting. You've done it in introductory accounting. There's going to be a few things we're going to add on, but I really hope it feels natural to you and just really falls into place as we go through it. So enjoy it. Let's go and have a look at how to measure inventories in IS2. Right, let's start nice and slowly. Easy example, nothing new to you. They just want you to work out the cost of purchase, which is paragraph 11. Basically, paragraph 11 is to do with a retailer, so somebody that's buying clothing from various manufacturers, Adidas, Nike, whatever the case is, and then reselling it to the public. An example could be an Edgar's shop or something like that. So you're purchasing inventories, you're getting them from the supplier to your shop and selling them to your customers. So the example that's there next to it is very simple as well. They just tell you that these are the various costs and you can match them across to paragraph 11. The first thing you'll see there is a deduction of discounts, which is the last sentence in paragraph 11, that discounts, etc. are not included. So we take them out of the cost. The one that we must maybe talk about a little bit that does cause some confusion sometimes is insurance expense. Remember, when you are costing your inventories, and we're in IS2 inventories, the statement of financial position, the asset inventories, you want costs in there to do with those inventories, to bring them to the condition to sell or to make them, which is more paragraph 12, 13, and 14 that you can see. But the cost has to happen before those things are finished. So with insurance, if I'm insuring my warehouse against a fire or something while I'm storing my inventories, that's not really doing anything to my inventories. It's not adding any value to them. It's protecting them. It's protecting my business. So that doesn't generally get capitalized as part of your cost of your inventories. But if you have, for an example, a production process that happens across two sites, and you have to transfer your inventories between those two sites while they're in production, and there's risk involved in that, so you have insurance for the transporting of those products between the two sites. That's more a cost that's part of the actual production process. So if you can see that a cost is part of your production process, that generally forms then part of your cost of inventories. But once your inventories are finished, and I'm just going to move them from warehouse A to warehouse B, that's not adding any value to my inventory. So any cost after they are finished is generally just expense straight through to profit or loss, as an insurance expense in this example. So there is the general principle around that the costs need to influence the condition of your inventories to get them ready to sell. If it doesn't do that, then those things aren't capitalized. Now, something else I just want to show you is there's different ways of calculating it. Two mainly that you could play around with. This example shows you the one where you just take the costs as they're given to you. They tell you this were the costs incurred, you add them up, and you get to an answer for it. I just want to take you through to another example and just remind you that you could do this also on a per unit cost basis. So I've scrolled down to one of the later examples, and I just want to have a look there in the middle of your screen on the right hand side. You'll see raw materials, and they've got an amount of 3 Rand, 2 Rand 50, 4 Rand added up to 9 Rand 50, and then they times the 9 Rand 50 by the 30 units. So without getting distracted by anything else around it, just the unit costs times by the number of units. That's another way you can calculate your inventories. So deciding which one depends on the information available to you. Your end goal is to calculate the inventories that are on hand at a specific date. If my information is given to me in such a way that I'm just adding up total costs, that's fine, then do it that way. But it could be a scenario where they're concentrating more on units and they're concentrating on what it costs you per unit. then you might need to go another way to work it out. So it is something that I really encourage you, as you're practicing your eyes, to look at each question and try and work out for yourself, what's the easiest route to go here? Do I do it like the example one I've just shown you, or do I do it like this example and go with unit costs? I have on occasion seen questions where you can approach it from both directions, but generally I think there's usually one that really stands out to you, and then that'll be the easiest way to go in doing your calculations. Okay, so the principle that you've seen now in paragraph 11, let's just go back to paragraph 10. And they say there, the cost of inventory shall comprise all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their present location and condition. So we've discussed that now. We've given the example to you of inventories. Really nothing new. I don't think there's anything that you've heard from me now that is new. It's really a recap of introductory accounting. So if we move along onto the next page of your standard, paragraph 11, which we looked at the detail now with that example, it's just giving you a little bit more detail on paragraph 10. Again, nothing new there. Now the paragraphs that are coming, paragraph 12, also really not much new. Paragraph 12 is talking to you about the manufacturing process, and they say there the costs of conversion of inventory include costs directly related to the units of production, such as direct labor, you've heard of that, and the systematic allocation of fixed and variable production overheads. So really nothing new. I want to go further, and I want to look at paragraph 13. But before we do that, I need you to go and please just recap and make sure that you are completely comfortable with your introductory accounting manufacturing section. So go back, have a look at your raw materials account, your work in progress, your manufacturing account, going through to finished goods, and that you're comfortable with that. In particular, I want you to please look at your overheads. What did you do in introductory accounting? You did a thing called incurred overheads and allocated overheads. And then I'm going to recap that with you, and then we're going to add on what does IFRS teach us as well that you haven't done in introductory accounting. So pause this video or log off for a moment, and I'll see you just now.